Hello traders, I'm Luke from Disciplined Trader. This video is part of the Trading Basics series, and in this one we're going to be looking at technical analysis. We will look at what constitutes technical analysis and its different forms. So typically, a trader either takes a technical approach to trading or a fundamental approach. Some traders do try and incorporate both of these approaches into their trading, but more often than not, a trader will prefer one over the other. So what's the difference? Well, most fundamental traders attempt to gauge the intrinsic value of a particular product or market based on their analysis of their related qualitative and quantitative factors. They do this with a goal of comparing the value they derive from their analysis to the current market price of that product or market. If they feel that a product or market is under or overvalued when the comparison is made, then they trade that product or market on the back of their analysis, predicting that in some point in the future, the value they've derived will become the market value. If a trader was analysing a particular currency pair on the forex market, for example, these factors could be anything such as economic or financial news announcements specific to those currencies, any economic or financial statistics specific to those currencies, or any macroeconomic data which they feel may have an effect on the value of that currency pair. Purely technical traders, on the other hand, don't really use any of these techniques. Technical traders work on the assumption that all available information in relation to a product or market is already factored into the current market price, and so this price already represents the intrinsic value of that product or market. Technical traders also believe that price movement within a market is not purely random, but instead moves in repeatable and identifiable patterns that can be utilised to gain a profitable edge in the market, when paired with good risk management rules. I personally fall into this category, and although I do not trade with a fundamental approach, as mentioned in previous videos, I am aware of any potential high-impact news announcement on the days that I'm trading, as I don't want to get caught in any news-induced volatility. So in a nutshell, technical analysis is an analytical approach that a trader uses to forecast where they think the price of a particular market may move to. Through this analysis, they identify potential entry and exit points for any trading opportunities that their analysis highlights. So how do they do this? Well, there is a vast array of tools and analytical methods technical analysts use, and I want to introduce you to the basics of the most common methods in this short video. Let's start with trend analysis. Put simply, the market trend is essentially the general direction a market is heading. A market can trend in three directions: up, down, and sideways. A market that is said to be in an uptrend typically will be making higher highs and higher lows, as a market in a downtrend will be making lower lows and lower highs. A market trending sideways will typically not be making any significant process, higher or lower. The trend of a market is very important to some traders, as they will only trade in the direction of the trend. They do this as they work on the assumption the trend will continue, so there is likely going to be more progress to the direction of the trend than against it. Any trades that are taken against the trend of a market are referred to as counter-trend trades. Some traders even specialise as counter-trend traders and look to take advantage of price pullbacks within a trending market. Usually counter-trend traders are working with the concept of mean reversion, which basically means that they expect the price to always revert back to a long-term average at some point in time. They build their strategy around forecasting the most successful mean reversion opportunities. The next analytical method I want to introduce you to is the analysis of candlestick and chart patterns. Candlestick patterns are specific patterns of one or more candles that form in such a way as to give the trader an indication of the market sentiment. Some examples of candlestick patterns are the doji candle, the engulfing candle, the hammer candle, the shooting star candle, the pacing pattern, harami candles, and tweezers. All these candlestick patterns are used to give clues as to the balance of supply and demand after their formation. The shooting star candle pattern, for example, is often assigned to a trader that selling has come into the market at that level and overtook the buying, meaning price may start to sell off from this point. Whereas the doji candle is often interpreted as both buyers and sellers matching each other in equal volume, as the price has moved up and down but finished where it originally started. Moving on to chart patterns, and this form of analysis is similar to candlestick patterns, in that the pattern that form is indicative of where the price may move next. However, these patterns care less what the individual candles look like, and more what the overall path of the price movement looks like. Some of the most commonly known and used patterns are double tops and double bottoms, the head and shoulders pattern, ascending and descending triangles, flag patterns, and channels. These patterns typically fall into one of two categories, either reversal or continuation patterns. As suggested, the pattern indicates whether a trend will likely expire and start to reverse on completion of the pattern, or whether the trend will continue in its original direction. Identifying these patterns can be somewhat subjective, as they rarely look as clean-cut as they do in the textbooks. I would highly recommend spending some time looking at historical charts and practicing identifying these patterns if it's something you think you might want to incorporate into your own trading. I'll be making a more in-depth video on candlestick and chart patterns, so subscribe to the channel if you want to be notified when that's uploaded. Next on the list is support and resistance, and this form of analysis is the foundation of my own trading approach. Support and resistance refers to price levels within a market where the potential for a reaction is higher than other levels. It works on the principle that what happened in the past is likely to happen again in the future, so it's possible to identify levels of support and resistance by looking at the past price action and identifying where the price had strong reactions. Then, when price approaches these levels again in the future, you can look for price to react at these levels. A key characteristic of support and resistance is once a level is broken, it becomes the opposite to what it was before. What I mean by this is if a strong level of resistance is broken and price moves past it, when price returns to this level, there is a good chance that the level will act as a strong area of support for price, and vice versa. Areas of support and resistance identified from previous price data at fixed levels are called static support and resistance. There are also forms of dynamic support and resistance, whose price level changes on factors such as time and price movement. A good example of this would be trend lines or trend channels. Trend lines are sloping lines of support and resistance that tend to connect a series of highs or a series of lows. Trend channels are simply two parallel sloping trend lines that tend to encapsulate a trending price move. However, as with the static lines of support and resistance, if a line is broken, they quite often can become the opposite to what it was before. I have made a much more in-depth video on support and resistance if you're interested in the topic, and I'll leave the link to it in the description below. The last analytical method I want to introduce you to is the use of technical indicators. As I'm sure you've noticed from the last section, identifying patterns and support and resistance levels can be somewhat subjective. Technical indicators use the market data and specific formulas to display that market data from another perspective that allows a trader to analyse a market much more objectively. One of the most commonly used indicators is the moving average. A moving average plots a line over the price data showing how the average price has changed over time. The most commonly used time period for a moving average is probably the 200 moving average. This takes the average closing price of the previous 200 candles for each point in time and connects all these points to make a smooth line. Traders can then use this line to help ascertain the trend of a market or use it as a dynamic form of support and resistance. Other common technical indicators include the Relative Strength Index, the RSI, stochastics oscillators, Bollinger Bands, and the Moving Average Convergence Divergence, MACD. I will also be making a more in-depth video on technical indicators, so please subscribe to the channel to be notified when this is uploaded. So that only really covers a taster into the world of technical analysis. It's worth noting that it is very unlikely that using any one method of technical analysis in isolation would result in profitable long-term trading. The aim of a technical trader is to gain an edge in the market through multiple streams of analysis coming together to highlight high probability trading opportunities. If that trader can then act on that edge in a consistent and disciplined manner, they should be able to profit from the market edge over the long term. So that wraps up this introduction into technical analysis. I hope you have found this useful. If you have enjoyed the video, please feel free to drop a like on it. If you have any questions or want me to cover any other topics in future videos, please let me know in the comments below. Also, subscribe to the channel for more videos like this one. I will be continuing this Trading Basics series to provide new traders with all the knowledge they need to get started. Thank you very much for watching, and I hope you all have a good trading week.